A testament to this community, to SOCAP, over the last decade and a half plus, grown impact investing from nothing to something quite substantive. And yet, impact is still bespoke. It is still niche, and I think, and I am complicit, it is a community that has a tendency to talk to ourselves. And the people disproportionately building the future are doing so in a way that is often antithetical or antagonistic to the values of a lot of people in this community, even though we know that impact does not have to be concessionary, and we know that it can actually generate alpha. We know that growth at all costs and move fast and break things mentality of much of Silicon Valley no longer serves us, especially as technology becomes exponentially more powerful and pervasive. Just super quick anecdote. The undergraduates I teach at MIT know viscerally that the last generation of kind of unfettered technology development has not brought them closer to the society that they want to live in, and that it hasn't brought any of us closer to the society, I think, that we want to live in. And yet, when they graduate, disproportionately, especially if they're thinking about starting a technology company, they will go to a place like Y Combinator, still the default first check for aspiring founders. And I say this as a former participant in Y Combinator, a place that is neither equipped nor disposed to help founders think about what it means to steward technology responsibly. So where does that leave all of us? In spite of the extraordinary accomplishments of the impact community and a new generation of emerging fund managers, we don't have a coordinated, competitive alternative to growth at all cost capital. So what would it look like to create an early stage funding ecosystem that truly prioritizes human dignity and flourishing? I'm so excited to have this conversation with these three incredible panelists with exhaustive and wildly impressive bios that I'm mostly going to let you research on your own so we can jump into the discussion. I will just quickly say to my immediate left, we have my friend and sometimes collaborator, Davida Herzl. Davida is the CEO and founder of an incredible company, climate tech company called Acclima, which does mission measurement of all kinds. And on her 40 million Series B, she converted to a public benefit corporation. Yeah, that is worth a round of applause on its own. And is truly a beacon and an aspirational founder, I think, in the space. To her left, we have Roy Bahat, who makes me think of this really terrific piece that I would encourage everyone to read called On the Edge of the Inside by Richard Rohr. And in this piece, Rohr says, he describes someone on the edge of the inside as someone who has to balance the small bubble in the glass between here and there, between yes and no, between loyalty and critique. Must have these perspectives in a loving and necessary creative tension, a kind of seeing and living which largely leaves this person with nowhere to lay their head. And when I think of Roy, I think of someone who
nowhere to lay his head.
operates in, with a truly independent mentality around how technology is built and funded. He has incredible credibility in Silicon Valley circles and prioritizes dignity and impact in his work in really unique ways. We're thrilled to have Roy here. And to his left, we have another pioneer, Katie Knight, who leads the Siegel Family Foundation, or the Siegel Family Endowment, one of the most forward-thinking, nimble foundations building out a portfolio of critical tech and society work. Disclaimer, I'm lucky to be a recipient of some of that support. Truly incredible panel, and now I want to jump right in. And Davida, I'd love to start with you. At one point, you have said that who you take money from defines your destiny. And you have had a pretty extraordinary fundraising journey. You also recently closed, was it a $20 million deal?
An extension.
Well, I was going to say with the state of California.
Oh, with the state of California, $30 million.
Excuse me, a $30 million contract What's 50% between friends? $30 million contract with the state of California to do emissions measurement. And I should say, throughout Acclima's business model thinks all the way down to kind of last model opportunities for economic mobility. So can you share a little bit about your journey in finding values-driven capital?
Yeah, it's really hard. And it was really hard for us because what we do is we measure emissions. So we measure all the regulated air pollutants that are regulated under the Clean Air Act. We also measure all greenhouse gases, and now we also do toxics. This contract that Lyle was talking about is doing all of those measurements in 64 environmental justice communities across the state that have been left behind by climate action in the state of California, the leading state in the nation on climate. And so it's a really groundbreaking contract. But figuring out how to create data that the scientific community, and more importantly, that the regulators could absorb and rely on, extremely difficult technical challenge. It's about as deep tech, hard tech as it gets. And when we started building all of this, which was a little, like maybe 8 or 10 years ago, the impact community was not as mature as it is today. And so I had to do a lot of door knocking, a lot of direct networking. We ended up putting together an incredible Series A that included Kat Taylor. They were actually my original sort of investors, and Tom Steyer. Together, before Galvanize, they had a fund called Radical. We also brought in the Schmidt Family Foundation, Emerson, the Capers, a really amazing group of folks that were very patient and understood how important it was to actually solve this technical problem, that it's a first order problem when it comes to the issue of climate change. So under the law, you can't regulate anything if you can't measure it. And part of the reason that we're in this crisis is that in 1970, when the law was passed, it was tied to the technology of the time. So I saw that problem and said, we really need to solve this. And so I started that journey about 10 years ago. But as we grew, we launched into a global partnership with Google. We launched into a national partnership with the EPA. This has been a very long journey. And as we grew, we started to run up against the wall of the absence of impact investors, and investors that were actually focused on growing these technologies with the same kind of patience. And the kind of inability to identify those investors meant that I had to bring in a few of those investors. And the fact that we had both impact and more traditional financial investors, we talk about diversity in this community, right? And diversity is actually really important because when you're confronting as a founder, when you confront different challenges, you have to build coalitions. And having the legal structure of a public benefit corporation gave my board and my investors the capacity to think about fiduciary beyond just profit. But it also, that coalition of impact and more traditional financial investors enabled me to bring in that capital, but also leverage that community of impact to actually land where we needed to land for specific outcomes and different challenges that we faced.
So I think you shared the other day that you're the first woman or the only woman of color to raise over $100 million.
I'm the first woman of Latin descent in the history of Silicon Valley to raise more than $100 million.
So incredible. Shouldn't have to be the case.
No, I mean it took 6 years. Yeah, it was really freaking hard. It shouldn't have to be as hard as it was. And if my name was Steve, and I was a dropout from Stanford, and I had put AI next to the name of my company, that would have been my seat check. Let's not forget what the ecosystem looks like. And here, my company is trying to solve an existential problem for humanity, and it took me 6 years. It shouldn't have to be that way, but it was.
So, solving an existential problem, winning 8-figure contracts from the public sector.
Partnering with Google.
Partnered with Google.
Yeah.
Fastco, most innovative, Time, most innovative, all these awards, and still. The challenges in finding values-driven capital. And so at certain points, you had to build coalitions, like you said. And maybe we'll come back a little bit later to some of the challenges that came from maybe not having every one of your investors being values-driven.
Right.
So Roy, I'd love to, you I think you have founders in your portfolio that I think have similar ambitions and value sets to DaVita, who truly prioritize social impact and believe that alpha can follow real social impact. I'm curious, would you call yourself an impact investor?
No.
And so, I mean, I kind of knew the answer to that. But so it would be great, though, if you could talk about, well, why not? And more specifically, how you think that label would affect your ability to do your job and communicate with some of your primary stakeholders, how it might affect your deal flow, maybe some of your other co-investors who are more traditional Silicon Valley investors, and so on.
So we're walking into this room friends, and I hope we can walk out friends, but I'm going to share some perspectives. So we have a modest-sized venture capital fund. We invest in the future of work, which is a category that has lots of social implications. You know, I spend a lot of my time with organized labor and advocates and elected officials trying to figure out how technology can have a better effect in the world. And I don't think the world is as simple as values aligned versus not values aligned. I mean, some of the most cruel, awful people I've ever worked with are in values-driven organizations. I mean, you've all seen this out there. Some of the most courageous, noble people I've seen are ruthless capitalists. So the exceptions abound, and that makes it hard to figure out what to do, because I think capital thrives on routine. And it shouldn't be that hard. You shouldn't need to run the exceptions in order to make something work. And so I don't actually think many of the founders in our portfolio would say, I'm fundamentally motivated by social impact, and yet I think alpha can follow. That may be true, but I think they see them as more inextricable in lots of cases. And you know, the tale I often tell on this is the tale of the evil twin company. So this is the tale. Imagine you've started a business because you believe it's going to have some positive impact on the world. And yeah, you'd like to make some money too, but that's not really the main reason you're doing it. I mean, if you want to make money, there are lots better ways to do that than starting a startup. And then you have another company come along, and it's your evil twin. It does everything that you do. It makes every claim that you make, only actually when you're making the responsible choices, it's making under the hood the irresponsible choices. If the evil twin beats you in the market, then the fact that you were good does not matter. And so I think that in general, in change making, we are addicted to the glorious complaint, like, I wanted to, but I just couldn't because reason. And the reasons are often really valid. The reasons are often structural inequality or biases, whatever they are. But there's something psychologically satisfying about being able to say, I tried to do it, but I couldn't because of something outside of my control. And I guess my fundamental take is between winning and changing the world, you don't get to choose. Like, you have to do both. And I don't label myself an impact investor, even though I care enormously about the impact that the companies we invest in and that we have through our example have on the world, is because many of the founders who most want to win would run away from us. They would not want to be associated with us. I mean, it is a negative signal to a financial investor, to most financial investors. When the prior round was done primarily by investors who label themselves as impact investors, because they just think this company may not care that much about actually existing in the future. And so that's why we don't label ourselves that way. And it's a real dilemma, because at the same time, I'm not saying, if you follow the logic of the market, you will have a better world. Obviously, that's not true. And so what do we do about that, to me, is the question.
I really appreciate that framing, and now want to bring it to Katie. So Katie, SFE the Siegel Family Endowment has been out front in trying to foster this ecosystem of public interest technology. And initially, I think that focus was in the social sector and the public sector, and increasingly there's this recognition that that there needs to be some type of private sector thesis as well, or a component, private sector component to the thesis. So when you hear Roy say having someone who prioritizes impact at the front of your capital stack is a negative signal, how do you think about, like, what are the implications for, do you think the broader vision or mission of SFE in kind of fostering the broader public interest technology ecosystem?
Yeah, I think the unfortunate reality is that Roy's right. I think I'll also say something complimentary about Roy, which is that you're not just sitting back and saying this, you're also active in conversations around policy and the way the macro factors need to change for what you're talking about to be true and still be pro-social, right? So it's one thing to not be an impact investor, it's another thing to be an investor who cares about impact on the world, and I think you're doing the latter, and that's what we need more of, which is why pushing into the private sector with our public interest technology work has been important. But to be quite honest, we've had a pin in the private sector strategy on public interest technology since we started talking about it, because there's always this big question of, well, how do we break in? How do we change their minds about alpha and about what the future needs to look like? And how do we force this perspective that we have that you should not aim to destroy the world, right? That being Dr. Doom isn't actually that great. I think in some ways, we had to wait for the external factors to change to be able to really articulate a private sector strategy. And in others, we had to wait for the narrative that being Dr. Doom isn't that great to catch on. So in some ways, the tech industry in Silicon Valley and a certain subset of Silicon Valley folks have made the case for us with their behaviors and what they have done and how publicly they've been sort of like, we actually don't care. We don't care about anything other than investor returns. And so I think that helps drive the conversation forward. But at the same time, we've had to make it clear why it matters. For us at Siegel, everything comes down to infrastructure, right? And building on top of everyone having the equal access to the opportunity to thrive in the world that we have. And so when I think about public interest technology, when I think about VC versus impact, it's actually more about, like, what is the infrastructure of this space? What is the infrastructure for building a tech company, for being a part of this community? What are the social infrastructures that exist for you to connect with like-minded founders and with the right kind of investors? What are the digital infrastructures that exist for you to have access so that if you're someone who's trying to start a company or build a technology that could be world-changing in a positive way, it's not the deepest, hardest thing to do. You have access to some of the newest and best, even if you're not here to build whatever custom GPT chatbot, right? Like, how do we make those things a reality so that we're not just yelling at people all the time? Although I don't mind, I don't mind. But there's got to be more to it. Like, we have to be building for the field, not just saying, hey, you're wrong over and over again, because that's not been working.
I would like to invite all of you, if you hear something that you want to respond to from one of your fellow panelists, please just grab the mic. But I would push, I'll maybe try to bring us back a little bit to, this is for everyone. Is just how problematic this difference in approaches is or isn't. How you see kind of the relative influence of the venture capital community versus the impact community in funding transformational technologies or in defining the future of how we live, work, and play.
I mean, I can give my take on that just from observing. There's a huge AI conference in San Jose this week. I don't see these names there. I think that's the problem, is that it's not intermingling. And as founders, right, in terms of infrastructure, one of the things that founders aren't trained to think about is to diversify their cap tables and to actually proactively bring in impact investors alongside those financial investors so that when you inevitably run into those issues, you have somebody there that you can go to that can kind of be the Jiminy Cricket on your cap table. And part of doing the PBC, I think we talked about this when you interviewed me, the most powerful part of converting to the PBC, and it was like so much work, but what was really powerful about it was that I had to spend a half an hour to an hour on the phone with every single investor, explaining to them why this was so important to us and to the company. And having that conversation to actually explicitly align around values and why this might matter and why the expansion of the fiduciary was important was like transformational.
So I love this point, and it makes me want to revisit Roy's reluctance to call himself an impact investor. I mean, there are, Davida in a previous conversation that she had outlined, I think this competitive advantage to being a public benefit corporation, of being in fact focused, as the term she used was mission parity. You're able to communicate mission parity with your public sector clients who had a lot of downside risk and were giving out 8-figure deals, and it helped you win a whole bunch of deals. It also served as a signal, a broader signal to talent, and served as a competitive advantage that way. I think you can make the argument in maybe essential services where people are transacting in trust, in education, in healthcare, in financial inclusion, elements of climate tech, gov tech, where if you do have impact embedded and you are able to convey that mission parity, impact and alpha are intrinsically linked, I think, as you pointed out. So I would love to just dig more into, like, why not, in your thesis, Roy, you even say, you think that value will follow companies that help people achieve a, quote, stable, dignified life. It sounds like pretty impact to me.
So what's the question?
So
no, I think this is, some of it is like, oftentimes the question is, what problem are we really trying to solve by calling something an impact investment? And you mentioned that sometimes it's because you're trying to tell the LPs, the investors in those funds, that you're doing something concessionary. Prepare for lower returns in exchange for having an impact. And I just don't think that there's like some Pareto frontier where you trade off between those things. I think they're kind of they're both fused, and you can make decisions about them independently of one another. So I guess, the question to me is, what problem are we trying to, why do I need to call myself that?
And just to add to that, I think, short-term versus long-term value creation and what value looks like in the short versus long-term, there's definitely a drive to, for example, get as much sales as possible in, we spend a lot of time in ed tech, which is often like very impact investment heavy, but traditional investors are looking for ed tech companies to have tons of sales growth no matter what. And then if they fall off a cliff because they weren't actually impacting students at all, then it's like, oh, well, but we could have solved for that up front if we were looking at whether or not the company had any positive impact on student performance. And so the same is true across sectors. Like, are you looking for the next 3 years, the next 10 years? Are you looking out longer than that when you think about what it looks like to see a return?
Yeah, and I can make I think that's such a good point. And another way of making that concrete, there are concrete trade-offs that I know how to define. Short-term versus long-term is a concrete trade-off we can talk about. The other one is big versus small. The only capital market we really have for businesses that are startups that's really well defined for getting going is the venture capital market. The venture capital market is really only, with there are exceptions, but in the main, appropriate only if you are trying to create one of the most financially successful companies in the history of capitalism. You can have a lot of impact on the world. You can build intergenerational wealth for the founders and their families. You can create returns for investors without trying to create one of the biggest companies in the history of capitalism. And I think that if we had capital alternatives, and there are many people working on this kind of stuff, that knew how to routinize making smaller companies that still thrive, then it would create a lot more degrees of freedom for different forms of impact.
I'm happy. I feel like I'm almost surprised that it took us to this point to get to. I think maybe this idea of what incentive structures are maybe routinized in venture capital as it stands, and I think to this call out to maybe try to be even more particular about, well, which question are we asking? I'm curious. How do we think, we talk about short-term versus long-term, or aspiring to something that may not just be one of the most successful financial companies of all time, but what type of maybe alternate incentive structures?
Yeah, I think that we can be really concrete about that too. there are plenty of investor incentive structures that exist for companies that are not trying to be one of the greatest companies in the history of capitalism. I mean, most private equity-backed businesses do not have that as an aspiration. I think that the kinds of companies that tend to bucket themselves as impact in terms of brand are often what I call high-risk, medium-return companies. They're just as risky as the companies that could end up being one of the greatest companies in the history of capitalism, but the prize isn't as big. So obviously in the market, they're going to lose when it comes to trying to find as wide an array of capital. They'll have a narrower set of investors. And so I think we have to figure out how to make those things lower risk. Otherwise, there are lots of other forms of capital for high risk, low financial return ideas. Academic research, nonprofit grants, et cetera. And then one has to ask oneself, when is it appropriate for the thing to be a business versus some other corporate form?
So
I can answer the question about why we chose to become a corporation. When we're talking about climate change and you want to impact a problem as global and as big as climate change, there's no way we could do it as a nonprofit, right? I would look at okay, which organizations have had the biggest impact on the planet? It's Walmart, it's Starbucks, right? They've transformed landscapes. Why couldn't we do that as a business? And so that was why, for us, it was really important to be a corporation.
So to bring together maybe kind of vehicle for impact and what infrastructure might be needed for different incentive structures, I think naturally come to philanthropy and money that is, I guess, necessarily or implicitly or should be either concessionary or risk-first capital. And so, Katie, I'm curious, especially as I think about maybe one of the dissonances, Roy, is when I, both in my experience as a founder and when I think about my students, if they're interested in starting a company, VC is still, they're taught culturally that this is your one-stop shop, right? And so even if they're not necessarily interested in building one of the most financially successful companies of all time. So Katie, when we think about that from an infrastructure perspective, what interesting things have you seen? What are you bullish on?
Yeah, I mean, everything comes back to philanthropy. Everyone comes to philanthropy one way or another. I think, so fundamentally philanthropy kind of pisses me off, even though I practice it for a living. So just put that out there. But because I think we lack the imagination to use all of the tools at our disposal in a really meaningful way and then be in conversation with the rest of the capital space. I find that you don't often enough hear about philanthropy as a capital flow. It's thought of in many other places and sometimes brought into the conversation as capital, but usually in conversations like this where it's well, can figure it out with all the other options, so what can philanthropy do about it? And I think if we, in philanthropy, could be more engaged in thinking about program-related investments and mission-related investments and how we invest of our endowments, and I'm saying this saying we haven't gotten it all right either, and there's certainly still capital that we could unlock, and some of that is because I have to help my colleagues that work on the investment side understand why I want to push in this direction and why we belong in the capital flows conversation. But we have the opportunity as risk capital, as concessionary, with, I always say, philanthropy is so incredibly unrestricted. The IRS asks 2 things of us. Everything else is just do what you want. It's a free-for-all. You want to do something good? Awesome. And we don't really leverage that enough. We don't really get involved in thinking about the startups, and even if you don't want to invest directly, right? I don't know that we at Siegel will do a ton of direct investments in individual companies because it would involve building a capacity we don't necessarily have. But there are plenty of funds that we can be in. And there are plenty of opportunities, no matter your level of risk, that appetite to be involved in as philanthropists in this sort of conversation in this field. And even if you don't want to make the investments at all, you can still be involved in thinking differently about who you're bringing around the table when you talk about what issue, in terms of climate change, when we're talking about solving for climate change, we cannot have that conversation with just nonprofit organizations and government organizations. It's just not going to get us where we need to go. So how can philanthropy, which has this incredible power to convene, and we love convening people, how do we think about those convenings as a different opportunity to change the conversation? How do we think about the opportunity to be at other tables ourselves? That's the stuff that I think would be really useful from a leverage perspective in engaging more with defining impact too. One of my issues with the impact investing space is that we don't really have a collaborative definition of that impact. And not that we have to, but there's got to be some standards. And shouldn't philanthropy and those who consider themselves impact investors be in conversation together to define those standards? I would think so.
Quick temperature check for folks in the room. Can you please raise your hand if you work in philanthropy? If you are an LP? GP? Founder, operator? Hey, founder operators. Okay, that's great, like kind of an even split. So I think we've sort of settled that, okay, in the first place, there needs to be maybe philanthropy. If we want to create new incentive structures, we need capital that is expressly willing to take on a different type of risk, maybe playing that role. I want to come back to this, and then on the other hand, we've also said that impact. Just because you have folks on your cap table who are impact doesn't mean you're set up for success from an impact or a financial perspective. And just because you have more traditional VC folks on your cap table doesn't mean you're set up in the other way. Davida, as the founder operator at the on the panel, can you still speak a little bit to the differences in your experience in how in having that coalition on your cap table, how have different actors maybe encouraged you to think about value or discouraged you to think about value?
Yeah, well, I think in every case, no matter what investor I'm talking about, we have to perform financially. Like, that requirement doesn't go away. And, I think that our impact investors are very much aligned around the kind of impact that we want to have on the problem, on society, but we need to be making money along the way. And so I think as founders, it's also really important to recognize this is not concessionary, right? We have to perform. And we have to perform in an ecosystem where we're often working against the status quo, right? That wants you to be something else. In our case, like, emitters don't want us to take these measurements, right? So it's kind of a big deal. And having impact investors on the cap table enables us as a company to be really courageous about that. Because it takes courage, whether you're confronting the status quo in oil and gas or in other kinds of spaces. It just takes a lot of courage as a founder and a team to get out there and do this. And so I think, having that combination of investors, and my financial investors, they're like, just go work with oil and gas. Just team up with them. And we actually have successfully in the past pulled that off. It's really hard, but it's possible. And just having that combination that I think reflects for us, a very broad swath of society, right? Very financially motivated, financially driven investors, combined with investors that are really in it for the good, right? That are actually okay with the investment being concessionary. It kind of puts us in, it gives us a lot of, a breadth of expertise that we can draw from as we're coming up against these business goals. But again, my mission and what I have to do is perform financially, no matter what. And so having that combination of folks is really helpful.
So, Roy, even though you eschew the impact investor label, have you found yourself co-investing maybe with more traditional folks in the Valley where from, if we don't want to call it a values perspective, but maybe a kind of a breadth of impact perspective, how often do you maybe find yourself in tension with their worldview?
A lot.
Yeah.
I mean, look, I grew up in the New York work culture where if you shake hands with somebody and don't honor your deal. There are circles where you'll never do another deal again. Whereas in Silicon Valley, people like to say like, oh, that founder's merely slippery, meaning like they're just a little dishonest. And so I have those conflicts all the time. And I'll just say, you know, I'll throw into our stew of problems to solve or considerations. You know, even the most ruthless capitalist believes they have moral lines. And by the way, they virtually all do. I mean, almost every LP agreement from a financial investor describes categories you can't invest in. They're not, generally speaking, investing in gambling. You know, I have a friend who's a very successful financial investor who had an opportunity to invest in OnlyFans and looked at it financially and was like, this is maybe one of the best performing investments I could possibly imagine, and I can't live with myself if I, you know, make this investment. I'm not making, you know, any judgment about it. I'm just saying that even ruthless capitalists have these lines. And, you know, I keep thinking about, Katie, about this word infrastructure that you used and thinking, what kind of infrastructure do I think could shift things? And this one feels like a bit of a cop-out answer because I'm not quite sure how to make this happen. But most of the important questions that a founder answers never come to your investors. I mean, as a former founder myself, you do 1,000 things that even just explaining to your investors would take so much time that you'd never be able to do it. And so there's a moral infrastructure that the creators of organizations bring, and I don't want to put it all on founders, that their GPs and LPs also bring, that, I don't know, like there's not really a good substitute to like learning it in school or along the way, or having, I was fortunate I had really good role models, I think. But, you know, we have this course that we've hosted for a few years that is now independent, that's done by a few Stanford faculty based on an undergrad course they teach about ethics and technology. And, you know, that's the kind of thing that I think can create infrastructure. I also think examples and diverse cap tables can help too. I mean, I think of when Omidyar Network and a number of other philanthropically geared organizations invested in Anthropic. And so the stew's complicated, and I don't know a good substitute other than we need people who are good at the skill of making ethical decisions. Not good people or bad people. Actually, let me just say one last complaint I have about impact, which is my guess is if you were going to do an exit poll from the people at SOCAP about who they plan to vote for president, we wouldn't really have much doubt in our minds about where that outcome would be. And the impact space, and I'll say this as a person who has backed many very progressive candidates, but has also worked for some Republicans, the impact space codes left, and that's a problem because it means that there's going to be a whole community that's just going to say, hey, that's not my identity. I don't want to be the person who leads meetings with pronouns. And again, I'm not judging that. In fact, very comfortable with it and happy to do it myself. But I think that if we want a space that has broad impact, it has to engage broadly with all these different communities.
So that funnels into, I guess, the final provocation before we open it up to questions. So this is for everyone. So we have a group of roughly evenly distributed GPs, LPs, founders, folks in philanthropy, with an impact bent. What is, if you had one wish for this community to help you be more effective in the work that you want to do, what would it be? Whoever wants to jump in first, and we'll try to hear from everyone.
I'll start. It only gets harder as you go down the line. I espouse a point of view I call technopragmatism, which is a problems-first approach to technology, and I swear that it's not just in response to techno-optimism. I've been referring to myself as a pragmatic futurist for much longer than that, but technopragmatism, i.e., the idea that we need not look at a new technology and say, how can I apply that to the problems I have, but rather look at the problems you have and think about what tools, technology, new, old, medium, age, might help solve it, and what non-technology problems might help solve it. So I think if we had a more pragmatic approach to thinking about where technologies, new technology should be applied as investors, that we might look differently at the companies and founders that we're choosing to work with.
I think stories are the biggest thing that I could see using more of. So much of how I've come to learn this space is through the examples that we've seen. I mean, I remember when I was earlier in my life as a VC, we'd have these conversations about impact investments, and I'd say, tell me a story about a good one. And they'd say, oh, when DBL Partners invested in Tesla. And, you know, easy to look at that then and say, like, they helped electrify cars. I don't know, was that what happened to Elon good or bad for the world in terms of impact? But like, we reason through those stories, and stories of extraordinary success or stories of things that could be repeated easily are both really valuable in different ways.
So I'm going to draw on two things that both of you said, but I think, I love the techno-pragmatist approach. What I would love to see, and I think this gets at what you were saying, kind of reducing polarity, right, between our communities, is I'd love to see both founders and investors, founders building from a first principles perspective, and investors investing from a first principles perspective, thinking about what problems do we need to solve, and what are the kind of underlying whys, and that should really guide the decision making around what we're doing. That has been so powerful in my company. We have to work. I mean, I work in climate change. We have to work with oil and gas. If I were to put on like a party hat on, I can't, right? But we're not going to solve the problems without that level of engagement. And so I just think that the problems that this community cares about really require that we think that way.
I think that's a great bridge into this question from the audience, and we've received a few. I think you're welcome to still submit. Thank you for submitting your thoughtful questions. So this one is, I'm an emerging fund manager with LPs who assess both financial and social impact. How do I not scare away traditional LPs for future funds? What's the best way to frame it? And I think each of you can maybe speak to this in a distinct way.
I can start with saying just, I think, specificity. So the more that you can speak to, I think, what your actual thesis is, and to Roy's earlier point, like time, like what are the trade-offs that you're making? What's the actual there? That seems like the right route to understanding and engaging with investors that will be aligned with you regardless of how they label themselves. But it's not everything is for every investor, and so it's about accepting who might be for you and who might not as well.
Yeah, I mean, I think my tough answer on that was going to be it might be too late, which is to say there's no rule that says that, hey, my fund one was 50-50 impact investors and rich people, but I want my fund two to be Stanford, MIT, and UTIMCO. That might, yes, I'm not saying people can't pull that off. They may be able to, but you may have made it, like there's path dependence in this stuff. You may have made a choice, and now you have to live with what are the consequences of that choice, advantages and disadvantages.
I mean, yes, they're the experts, but absolutely. I think really understanding what, your why is so important in any organization that you're founding and pitching, right? So, yeah.
I think that brings us to the next question, which I think is specifically for you, Roy.
Uh-oh.
It is, I'm just going to read it verbatim, okay?
We say we have to be in the same rooms together. That means we can't be so polite. And let me just say, like, we sit in these rooms, these fancy conferences. I remember when some people leafleted at Menlo, which is one of the investors in Uber, against something Uber had done. And I was like, I'm shocked that doesn't happen a lot more. So whatever you're about to say, I'm good.
To be fair, it's polite. It's
yeah.
direct.
All right. Well.
Which is what we need. Direct but polite. Is there a chance that Roy is too binary? We are an impact fund with multiple top quartile funds, and the idea that risk and return are relevant for every deal, regardless of impact. There's not quite a question there beyond is Roy too binary, but I suppose we can extrapolate a bit and think about.
You wanted me to give a yes/no answer to whether I'm too binary? Maybe. I mean, look, I'll just give you more examples to mess up everybody's heads.
Yeah, perfect.
One of the, I believe, the best for the world, high-impact startups we've ever invested in, is the most highly valued company in which we've ever invested, is a shipping broker, Flexport. Nobody would have said, oh, that's an impact investment, but they helped make, like, when COVID happened, you want your PPE? Guess what? It's got to come in containers. Somebody's got to do that work. And the founder was deeply focused on that. Another, I think, one of the most impactful investments we've made is a company called Replit that expands access to software programming. That founder was on Tucker Carlson like a few weeks ago. I don't know. Yeah, I saw somebody I saw your body language shift when I said it. Is that good, bad, indifferent? So if you, I don't know. I definitely am accused of binary thinking, but we have to live on the edge of the inside in order to make this stuff work. So could your impact fund be an exception to the rule? Of course it could be an exception to the rule.
So no, Roy, is not too binary. I think that's the answer.
Thank you.
Okay, so we haven't, I think, we've only alluded to the public sector, but I think it's worth invoking, and so we have a question expressly about how can government or policy maybe help bridge the gap between short-term impacts and long-term value. And I feel like, to bring it back, Roy, I think you're, the provocation you made in the beginning, which is trying to make sure we're asking the same question, or at least being clear about which question we're asking. While there are all sorts of different value buckets, it does feel like maybe one unifying umbrella could be this, this disposition towards creating short-term value versus having a longer-term time horizon for thinking about what it means to create value. So I will put this question to you in that context. How can government or policy maybe help bridge the gap between short-term impacts and long-term value? Just to anyone.
I'll start with something a little bit out of the box, I think, but one of my many half-baked theses on the world. I think government's investment in R&D that has so dried up, and there are great books and articles on this, but when I think about like where is innovation happening and why do we innovate for innovation's sake, and we push things to the limits and then try to figure out what to do with them, and I think in many ways it's because there's just a fundamental mismatch between like where the spaces are. And Roy was saying earlier, like if you have a high risk, low return idea, academic research is a great place for that. Well, the funding for academic research is not what it used to be. And so can government go back to investing more in R&D? That's a very potentially bipartisan, really interesting endeavor that might allow us to create the spaces where some of this, like, let's just see what the tech can do, let's just build whatever is interesting, might actually be more appropriate to live, and then those things sort of filter back out into the public sector, see the internet, for example. So that's one thing that I think, you know, is a more long-term interesting solution than some of the traditional regulatory things that we also think about.
I think that's fully baked. I mean, you know, like the way I describe government is the first venture capitalist. The only reason we have the whole tech sector is the internet, and Silicon Valley was built on the back of defense contracts, and the only reason we have AI is because of actually mostly Canadian and UK government investment, some US government investment. And I think the CHIPS and Science Act is one of the most important legislative achievements, you know, of my life. We obviously can do a lot more. So that's one huge category where I think government should embrace its role as the ultimate long-term risk investor. The idea that you would go to VCs and be like, hey, your pension fund LP should accept not being able to hit its pension fund obligations so we can have some impact. That's a tough burden to put on a GP. The other thing I think government can do is make it easier to invest in these vehicles. We have really antiquated rules that are designed to protect people from being exploited, but like the idea that, you know, a VC firm can only have a certain number of investors, where the lines are for accredited investors, like these all maintain classist, racist, sexist structures that block access to capital. And so I think government can find smarter ways to let money in and also to let money out, because then founders need to make money in order for the system to keep moving.
And I was just going to add, so in addition to what they said, I think there's another role that government plays that we don't really talk about a whole lot. But VCs and investors aren't going to invest in a market if that market doesn't exist. And so if we think about emissions measurement, for example, just to use our example, I kind of empathize with why I needed impact investors to kick this off. So I'm a lawyer turned entrepreneur, and I actually had to go change laws in the state of California and New York and the IRA to create space for our technology. Not a lot of people have that expertise, but you know, being able to, as government, understand not only can we deploy capital into early stage R&D, we can actually change the rules of the game so that there's like really big markets in some of these spaces, and in some of those spaces, government can be a huge source of procurement, but I think government actually has a really big role to play in unlocking a lot of this.
I have a brilliant friend who I think called what you're describing like policy market fit. Yes. The idea of kind of forging new, government has the ability to forge new markets and set the terms around how people participate in those markets. So I think, yeah, the public sector and policy have an enormous role to play. So we have a question, since I guess this person made a point to point out that there are no LPs on the panel. But
We invest in venture firms sometimes,
What's
so
that?
we are
Oh,
sometimes
fund
LP.
funds. Oh,
Yeah.
okay. There you go. So then you can answer this from both sides, Roy, or Katie and Davida, you can take it as well. How do we push more more LPs in VC to implement responsible tech or fuel responsible tech? And so I'd also back out Roy a little bit and ask, as a VC, how do you have conversations about responsible tech
Yeah.
with your founders?
Well, we have let me just say, we have an easy thing with our LP because the name's on the door, and the returns that we generate go to fund Bloomberg Philanthropies. And by the way, founders love that. They love, make us some money. It's going to go to fighting climate change and stopping guns and name your thing that you feel good about. With founders, it depends a lot on the individual circumstance. Let me be honest, there are deals where we get a half hour with the founder, and if we want in, we're begging. How much? I'm not going to hand them an impact questionnaire because I'm not going to be in that company. And so we have to figure out, as these situations come up, how do you? It sounds like somebody had that pain they lived through personally. How do you make sure that that you can have it? Now, often we have a few standard questions we ask. We're really transparent on our website. You can see, but a frequent question we'll ask is, in success, what's the dark underside of this business? Because what we're looking at there is ethical imagination. And I had a founder say to me, well, there are a lot of unintended consequences, but we're not going to be responsible for those. And I was like, I don't know that's how responsibility works, actually, buddy. And then you have that conversation. And we've had cases where we've had to step out of deals because we actually asked to sell our stake in a company once because we didn't trust the ethics of one of the new VCs. Now, that's an extreme situation. And so I guess I don't have a great systematic answer. I can only just say you have to look at each individual situation. And part of the tradecraft is, how do you introduce the things you care about in a way that's appropriate for the circumstances that you're in?
I'm going to revisit this binary question because I think your categorization of yourself in some ways could be too binary. I think in your practice, though, I think it sounds like you do a really important and innovative job at finding this argument for responsible tech and impact that is material to individual circumstances. And it seems implicit, and this has been true in my case, and at MIT and Cornell Tech, at Cornell Tech, I co-run our startup studio, and we have 400 students for better or worse, that have to take my class where they build a startup, and we recently implemented something called an ethical risk assessment. So as part of their final submission, they have to use one of many growing external frameworks for identifying technology risks, whether it be in contributing to surveillance state or algorithmic bias or data control and monetization and so on. And what was really, really interesting about now having graded a few hundred of these over the last few years is they map really well to the companies that we also have a venture fund on the backside that wound up getting investment. And when you think about the signal, if the job of investors is to look for signal through noise, this ability to have foresight about unintended consequences, especially ethical, is an incredibly powerful signal. Right? You think about great founders like Davida have extreme foresight, are very clear-eyed about the things that are going to be difficult in particular, and have the essential disposition of a successful founder where you can turn lemons into lemonade. Right? And so it sounds like, Roy, you are doing that, and so I would push back on this idea of maybe you are kind of an impact investor.
Look, first of all, it's really kind of you to say that. I would like my role and the role of our firm to make the world a better place. And so what I'm rejecting is the label as we currently construe it, not the practice of trying to make things better.
Well, that's an important distinction, right? That feels like a type of call out for this entire community, right? And to be fair, I think it comes back to this idea of storytelling and branding.
And look, and I just want to say, I'm not here to say we're special and we do things incredibly differently. Pretty much every venture firm we work with that's a good firm that knows how to invest in good companies has practices around these things. They sometimes get it wrong. They sometimes get it right. And so I think it's not a good guys, bad guys kind of a situation. It's a, what are you, I think Katie, you were sort of saying the why of, or maybe, Davida, maybe you said, I can't remember, I'm sorry. But it's to me, it's just having clarity about, Here's what we are trying to achieve. We have a strategy to go do it, and then go be fucking great at that. And a lot of the problem I see with the impact and philanthropic world is actually the desire to be winners is attenuated by the desire to do good, and you don't get to choose.
So I think we're coming up on time. I would ask, is there anything that you wish you had the chance to share that you didn't get the chance to share, each of you? Maybe we can go in reverse order. Davida, do you want to?
There's a lot.
Go for it.
But I'm not going to share all of it yet. But I will say that there are times when, I really appreciate this conversation. Thank you so much for inviting me. I think, and I agree, I think Roy is miscategorizing himself because he is actually engaging in the discipline of impact investing in a very focused, intentional, diligent way. And I agree. I think that there are practices like that in the investment community that reflect those same kinds of principles. So Roy, not to call you out, but I think that there may be another, and I think it's maybe a little bit of an allergy to the labels, which I'm also allergic to, because it puts you in a kind of cognitive bucket that maybe you don't belong in, right? And because we're so much more complex than this binary thing, are you impact or not, right? It's not really that simple. And questions of morality, there are questions like that we've encountered, some pretty big ones recently that I will talk about next year. But questions of morality are very nuanced. And you have to have a coalition of people that you can have really deep, really profound conversations with about the profound and big implications of your decisions. And so that's why I do encourage, I think, that diversified cap table, people on your cap table that you can call in when you have those kinds of considerations are just really, really important.
Thank you. Roy?
I'll just say that I learned through conversations like this one, including maybe reflecting on how I describe myself. But anybody who sits in front of a group like this and is like, we know exactly how to do it, we've figured it out, they're full of shit. We are all still inventing it as we go along, and that's why gatherings like this are so valuable and the questions are so valuable.
Yeah, I agree with all of that, and I think just to maybe double down a bit, I'd say we have the opportunity, again, to think differently about what it is beyond the categorization or the labels, what it is we are trying to do. Are you trying to build a company that will provide good jobs for people in the community where you live? Are you building a company that's trying to address the impact of climate change through emissions measurement? Are you building a company that's trying to serve students with learning differences using AI for personalization? The more that we can cut through the shiny wrappers and the BS that people have become accustomed to these marketing decks. I don't want to see another marketing deck. Tell me with words to my face what you're going to do. Obviously the capacity, don't actually do that because we'll get kicked out of the room after the session, but you know what I mean. I think the reality is we've got to stop building for these lofty promises, whether the promises are I will make $1 trillion or I will solve every problem in the world. Really being specific, really thinking what at Siegel we also, when we make grants or do research, we think about what will we learn from this, success or failure, right? And so really being able to be specific about each challenge you're trying to tackle, what the path you're thinking of taking to get there is, and what your intended and hopeful outcome will be, and what will happen if you don't reach that outcome. That's the kind of stuff that we should be digging into. And instead, we're having, I think, conversations about things that matter a lot less. And so if we can shift the dialogues that we're having to be more about specific intended outcomes, consequences, and all of that, then we'll be better for it. And maybe we won't have to spend as much time on whether or not we fit into one category, or whether the capital is actually concessionary or not, all of those things, right? That's the stuff that I think if we spent less time on that and more time on the actual issues, in spaces like this included, then we'd be probably solving a lot more problems than we currently are.
We're at time, and I want to thank each of you for your thoughtful, forthcoming reflections, and for each being a beacon in your own ways, for giving us examples of new stories of how people are building companies, funding them, and creating the infrastructure to do it in a way that maybe is not more expressly impact, but is more expressly intentional and thoughtful. So thanks to all of you.